Here are some good general points regarding gift tax. Now, we've got gift tax being a federal tax. Keep in mind, that's 99% of what we're seeing on this exam is federal taxation. We're not really dealing with states. We mentioned states and we mentioned states and local municipalities and their impact, but that's far and few between. Federal tax imposed on the transfer of property or assets from one person to another when nothing or less than full consideration is received in return. So that in reality, yeah, distinguishing between, in the real world, distinguishing between a transaction and a gift may be difficult. But for the purpose of the exam, we're not going to really have to determine if this was a gift or not. It'll pretty much tell you this was a gift. The person giving the gift, the donor, is generally responsible for paying the gift tax, as we saw. Here are some important points. Well, we've got this annual exclusion. Now, each donor can exclude gifts up to the annual exclusion, which is an amount that is constantly changing and that will be available here for you in the resources. So definitely open that up, memorize the amount. It's been $12,000, $13,000, $14,000, $15,000, $16,000, $17,000. It just keeps going up basically by $1,000, roughly every year or so, without triggering any gift tax. This amount is going to be indexed for inflation. As we said, changes year to year. For couples filing married jointly, the exclusion is double, as is with a lot of exceptions and exclusions. So it's main tax reason to get married, right? To get that double dip on that. So yeah, have that memorized, and we'll see a lot of examples. I know you all love them because guess what? I've heard from a lot of you that you love these numerical examples to really paint a picture as to what we're seeing and how it works. Now, here are gifts that have an unlimited exclusion, meaning that these certain types of payments are going to be excluded from gift tax regardless of the amount. These are going to include a couple of points, and these are common multiple choice questions, so make sure you know them. Payments made directly to educational institutions for tuition. It says a common trick, but there are a lot of tricks dealing with this in questions on the exam. Now, if I make a gift to a school for someone's tuition, I have to give that money directly to the organization. Similarly, if it's to a charitable organization or if I'm paying someone's medical bills, I cannot give that money to someone else. I cannot give that to the patient for them to give to the hospital. I cannot give the money to the student to give to the school. In order for this to be excluded from gift tax, I need to give the money directly to the institution receiving it. So that's definitely something to keep in mind. Another common trick for questions involving colleges is that even if fees for books, tuition, and room and board are paid directly to the institution, which that checks off the box I just mentioned, only books and tuition are not subject to gift tax. For the IRS, room and board are not essential, and as these payments would be considered taxable gifts. That's just kind of how the IRS works. They don't really view your college experience as needing to live on campus and have the dorm experience. So that's just kind of how you can remember that as well. But I mean, it's just how it works, right? Only books and tuition and direct expenses going towards your education are going to be excluded from the gift tax. As I said, also, payments made directly to healthcare provider for medical care. Directly, don't pass go, don't collect $200, give it right to the healthcare provider, not to the patient. Charitable gifts to qualified organizations. We got a whole section on that. It's called tax exempt orgs. And then gifts to spouse. So for the purposes of the exam, for the purposes of taxation, a spouse, someone you're married to, I mean, generally you file married filing jointly, but you also can do filing separately. But the IRS views you as one person, as one entity. Just as the IRS would view a corporation that wholly owns another corporation, they view that as one entity. So too, I mean, okay, with exception, right? Not to get into a whole nother topic on this lesson, but this is interspousal, intermarriage transfers. And, if I give if I'm already married to someone and I give them a gift, I give them a wedding ring, or they give me a car, it's kind of just like, all right, well, we're giving this between ourselves, so it's not really taxable. So that's what we say. Generally, gifts between spouses are not subject to gift tax. The IRS views us as one entity for the purposes of taxes, and we're just transferring it between ourselves. Let's see, what do we mean here about present interest? Well, gifts, and this is not as important as the prior slide, but it's definitely something to know. But just I like to give expectations as to, what is the most important to know. Gifts that qualify for the annual exclusion must be a present interest, which means that the recipient has immediate access to the gift. The present interest gifts allow the recipient to hope they enjoy the gift. Otherwise, maybe you gave them $30,000, and how do you not enjoy $30,000? Am I right? Or utilize the gift without any restrictions or conditions. These gifts are eligible for the annual exclusion, which helps reduce the taxable amount of the gift. Examples of present interest gifts include, we've got outright gifts given directly to the recipient without any conditions or restrictions, such as cash or personal property. We got trust income with mandatory distribution. This is going to refer to a trust that requires the income generated by the trust's assets to be distributed to the beneficiaries at specific intervals or under certain conditions. deal with that with all trusts and everything like that and that whole lesson. Life estates. A life estate is a type of property interest that allows a person to use or occupy a property for the duration of the life. The person holding the life estate is called a life tenant. We've got estates for a certain term. This is a property interest that lasts for a specified period or term, after which the property reverts to the grantor or another designated party. Bonds or notes, financial instruments that represent a debt owed by the issuer to the bondholder. The bondholder typically receives periodic interest payments and the return of principal at maturity. And lastly here, unrestricted transfers of life insurance policies. This refers to the transfer of ownership of a life insurance policy to another person or entity without any restrictions on how the policy can be used or managed. So like I said, the prior slide, you might see a lot of multiple choice coming from that. Here, I would definitely just know this and be familiar with it, but it's not going to be as direct. Now, future interests. We talked about present interests. Future interests, gifts that involve a future interest do not qualify for the annual exclusion, meaning you're going to have to pay tax on the full amount of transferring it. A future interest gift is one where the recipient's right to enjoy, again, hopefully they enjoy it, or access the gift is deferred until a later time or is contingent upon the occurrence of a specific event. When pigs fly, you'll get $1 million from me, right? Examples of future interest gifts include, well, we've got reversions. A reversion occurs when a property interest reverts back to the grantor, the original person who gave the gift, after the expiration of a life estate or a term of years. We got remainders, and a remainder interest is a future interest that becomes possessory when a preceding life estate or term certain expires. We've got trust income where the accumulation of income is mandatory. Well, again, this is kind of dealing with trust. You'll see that in that lesson. This refers to a trust that requires the income generated by the trust assets to be accumulated and held in the trust rather than be distributed to the beneficiaries. And lastly here, present interests without ascertainable value. These are going to be interests where the value of the present interest cannot be readily determined, such as a contingent interest that depends on the occurrence of an uncertain event. So, I mean, there's many examples for that, but we'll see examples as we run through, but just points to know for the exam. All right, a few more here before we dive into some more terms when we talk about complete and incomplete gifts. Well, just generally and super broad here, complete gifts. Only complete gifts qualify for the annual exclusion. Incomplete gifts, such as conditional or revocable gifts, do not qualify. Kind of covered that a little bit before, but make sure you know that. Recipients, generally gift tax is not imposed on the recipient. This is like the third time I'm mentioning it, so if you get any questions wrong because of that, I will be a little disappointed. I will not be disappointed, don't you worry, everyone makes mistakes. However, the recipient may be subject to tax on income generated from the gifted property. That's interesting, right? So if I give someone a rental property, they're not going to be taxed on the actual rental property. But if the rental property makes income, well, then that person will be taxed on that. And lastly here, but let's think about that with my analogy also. It's like I didn't ask to receive the gift. If I give someone a rental property and they don't want it, they can go and sell it. So they don't have to pay tax on the income generated by the rental property. That's kind of building on the example I gave before. Then lastly, we've got the generation skipping transfer tax. This is a separate tax imposed on gifts made to individuals who are 2 or more generations younger than the donor. This is designed to prevent individuals from avoiding estate tax by making large gifts to grandchildren or more remote descendants. This is a whole thing where, not to get into it, not to start to voice my own frustrations, but basically the IRS wants to tax assets, tax wealth on every generation. So it goes from generation A to B to C to D. You can't just from grandparents give money to the grandchildren and avoid tax. No, the IRS wants to see taxation at every level, at the grandparents, the parents, the kids of those kids, et cetera, and on and on. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.